Hi everybody, my name's Derek Fitzgerald, and I'm a retirement income expert. And I'm here to talk to you today about infinite banking. Now, I know there's a lot of information out there that you might have seen already on social media, all over the internet, and there's some good information, there's some not so great information. But I made this video so that we can cut through all of the noise and just get down to what infinite banking really is and what it can do for you so that you can make an informed decision on whether or not this is the right financial vehicle for your needs. Now, I'm a firm believer that if you can't explain something clearly and easily in language that everyone can understand, then you probably don't understand it well enough. So, with all the complexities that there are to infinite banking, the best way that I've found to describe it is to actually tell you what it does. So here's a testimonial from one of my clients. Her name's Jamie. She's a nurse. And it's a little wordy here, so let me break it down for you. I had nearly 12 years of scheduled debt payments piled up in front of me. Nursing school loans, a mortgage, cars, and credit cards. With my infinite bank, I'll be completely debt-free in 4.5 years, without adding a penny to my monthly bills. In 20 years, I'll have over $900,000 in assets. In 30 years, it'll be over $1.7 million. That money is my additional retirement income, and it's all tax-free. While the money's great, knowing that I'll be able to cut back on my hours and have more time to spend with my family is what really matters most. And just to take this a step further, just to share with you what I've been able to personally do with my clients over the last 6 months, well, I've been able to eliminate over $9 million of their debt. I've saved them in scheduled interest payments over $4 million, and I've built over $90 million in their retirement savings. I wish that this had been taught back in high school and college, but it wasn't. So the next best time to learn is now. Let's keep going. And what all of this is really coming down to is one basic question. If every dollar that you earned was suddenly worth $2, and all of your debts were paid off, would your life, or would your retirement, be more comfortable? I have to guess that you're probably saying yes, that it would. Because I've yet to run into that person who says, no, Derek, I want to just keep adding debt onto my plate, and I want to be paying off debt until I'm 103 years old. So let's get down to the fundamentals of infinite banking. First off, who uses infinite banking? Well, it started off 100 years ago with the Rockefellers. Fast forward a couple of years, and you've got Walt Disney taking a loan from his infinite bank and starting Disney World and Disneyland. You've also got guys like Ray Kroc, who started McDonald's with a loan from his infinite bank. Now, I don't know if that's a good thing in your eyes or a bad thing, but after however many billions of hamburgers that have been served, I would say that Ray made a good bet in taking a loan from his infinite bank. Now, who's using infinite banking today? Well, you've got basketball legend Magic Johnson, you've got the majority of U.S. Congress, and you've got Warren Buffett, arguably the most famous investor on the planet. But you don't have to be a billionaire to use infinite banking. You've got people like Nurse Jamie. You've got people like the rest of my clients who I've been helping. You've got me. You've got my family and friends that I've said, guys, stop what you're doing and just take an hour and listen to me about infinite banking because it's changing people's lives. It's that important. So when do you use infinite banking? Well, it's ideal for families who don't want to have debts during their retirement years. They want to become their own private bank. And for those people who want to pay off their mortgage, their car loans, their credit cards, their student loans, their personal loans, anything with an interest rate attached to it, without adding any additional payments every month. Now, I told you that I wasn't going to use a lot of financial jargon. So I think that if you take the concept of infinite banking down to its very core, the easiest way that I can describe it is to call it a savings account on steroids. And this savings account on steroids does several things. Okay? It gives you higher interest payments. It gives you guaranteed growth. It allows you to use every dollar twice. It gives you access to your cash without penalty. Certain financial vehicles, like a CD from a bank or maybe even an annuity, will penalize you for taking your money too soon out of those vehicles. This is not the case with infinite banking. It gives you the ability to generate additional income. All right, this is your side hustle without having to do anything else other than what we all have to do, which is finance our daily lives. Right? It gives you greater control of your money. It provides you tax-free income, it shelters your assets, and it gives you the ability to create generational wealth. And I'm going to unpack that in the next few slides. But ultimately, guys, I can't dance around this any longer. At some point, the rubber has to meet the road. What is infinite banking based on? Well, it's based on a participating whole life insurance policy. Now, before you start getting ideas, this is not your parents' or grandparents' whole life insurance policy. What we're doing is we're using the laws of the land and the U.S. tax code to create a protected and guaranteed financial vehicle, or a bank, that's wrapped inside of a life insurance policy. All right? And you benefit from owning both. And while this does have a death benefit like traditional life insurance, what we're doing here is we're minimizing the death benefit and we're maximizing the cash accumulation within the program. Now, right out of the gate, I think this is kind of like a mic drop moment right here. All right. In June of this year, the FDIC came out with a report stating that the average interest that banks are offering for us to keep our money in their banks, in their accounts, is 0.42% versus the 5.8% that you can earn in an infinite bank with the carrier that I'm thinking about right now. They've paid out at a performance rate of 5.8% over the past 3 years. Now, for those of you who might be thinking, oh, past 3 years, 5.8%, that's great. But Derek, have you buried something in year 4? Well, let's take a look at that. Here's the past 20 years. And as you can see, the lowest this has paid out in the past 20 years has been 5.6% in years 2009 and 2010. The highest it's paid out has been 6.83% in 2016. But this past 20 years has included 2008 and the housing market crisis. So when we had people losing their retirement incomes, losing their life savings to the housing market crisis, people who were using infinite banking from this carrier were earning at 6.32%. Now, it doesn't end there, because when you go back to these interest rates, infinite banking is providing in compounding interest. And for those of you who don't understand the differences between compounding interest and simple interest, is that simple interest is your principal plus your interest. Compounding interest is your principal plus your interest plus the interest on top of that interest on top of the principal. Old Albert Einstein here was a big fan of compounding interest. He always said that he who understands it earns it, and he who doesn't pays it. And that's actually a little more true than even he knew at the time, and I'll unpack that in just a second. But it's also illustrated in this question that you might see out on the internet from time to time, which is, would you rather get $1 million today, or would you rather have a penny doubled every day for the next 30 days? Now, I'm not going to make you wait too long on that one, because I'm just going to go to the next slide here and show you that if you take a penny doubled every day for the next 30 days, here's what it looks like. At the end of 30 days, that penny doubles every day to make $10.7 million. Now, I'm not suggesting that infinite banking is going to get you 2 pennies into $10.7 million in 30 days. It's not. This is 200% compounding interest daily versus what this carrier is providing at 5.8% compounding interest annually. But I can assure you that 5.8% annual compounding interest is going to beat 0.42% average of simple interest all day long, twice on Sunday. Next up, infinite banking provides you more value over time. It's the only financial vehicle where your contributions go down over time and your cash value and your death benefit go up. And the reason why you're looking at an arced line up right there, it's actually showing you the power of compounding interest. Using every dollar twice. Now, here's usually where people's brains start breaking. So bear with me, okay? I'm still not going to get very deep into the technical jargon of infinite banking. But if you had $10,000 in your local bank, Bank of America, Wells Fargo, Truist, you name it, You had $10,000 there and you take away 90% of that, or $9,000. How much money do you have left over? $1,000, right? Okay. Now, if you took that same $10,000 and you put it into your infinite bank and you took 90% or up to 90% or $9,000 out of that account, how much money do you have left then? Well, it's $10,000 because you're using something called non-direct loan recognition. Right? You're using other people's money. You're using the carrier's money. And if I take that a step further, infinite banking is the only financial vehicle where you can have one pile of cash that you can take money out of, all right? Use it outside the policy, pay off debts, finance purchases, go on vacation, whatever you want to do, while at the same time, that same pile of cash is still inside your policy, earning interest, saving for your future, to the tune of 5.8%, at least over the past 3 years. We say that it's better than a loan because it's already your money. And we say it's better than a savings account because you get to earn interest on the entire principal, even if you're using money outside the policy. Okay, now here is a traditional banking model that most people should be familiar with. You've got your income and you've got your checking account. So your income comes into your checking account, and then all of a sudden your bank says, well, if you open up a savings account, you can transfer money into your savings account, and we're going to give you a few extra points interest on your money. Your money will work harder for you. You say, great, I'll open up a savings account, and then I'll transfer money into my savings account. And then when my checking account starts running low, I'll transfer that money back into my checking account from my savings account, and I'll go spend that money. Now, there's two main problems with this. First off, between these two green lines in your checking account, I think we all pretty much know that the bank is taking our money and lending it to other people. They're marking it up with interest, and they're selling our money to other people to make money. Hey, I get it. They're a business. They're in it to make money. But they're making money off of our money, and we're not making money off of our money. The other thing that is the issue here is that with this model, it is $1 earned and $1 spent. There's no non-direct loan recognition in traditional banking. Now, if you swapped out your traditional savings account with an infinite bank, so you get $1,500 into your checking account, and you remember that I recommended on some video you watched a while back that you want to maximize your ability to make money on your money and minimize the ability for the bank to make money on your money. So you take $500 and you leave that in your checking account, and you transfer $1,000 into your infinite bank. And then you immediately take $900 or 90% of that 1,000 back out into your checking account, right? You just gave it a whiff. You're just filtering that money through your infinite bank and pulling it right back out. So now you have $900 out in the world, and you still have $1,000 sitting there in your infinite bank, earning you that 5.8% compounding interest. $1, two places at the same time. And then the next month comes, and you get another $1,500 in your checking account. So you keep $500 into your checking account while transferring $1,000 into your savings account on steroids, your infinite bank. And you take another 90% right back out. So now you have $1,800 outside the policy, while that original $2,000 still sits in your infinite bank, earning interest, saving for your future. And what happens when you do things this way is that 100% of the funds that you're transferring into your infinite bank, even if you take them right back out, are recognized immediately. Your credit limit is always 90% of your cash value of your infinite bank. Electronic transfer of funds, it usually takes several business days to transfer back and forth. This is not one of those things where you have a mobile app where you can transfer money from your savings account at Wells Fargo, and then you put them into your checking account and you blink and it's there already. This takes a little bit longer. When my wife and I use our infinite bank, we'll get money recognized on a Wednesday. We'll submit a withdrawal for $2,000. It's in our checking account by Friday. So it's usually 3 business days. So what we're doing is minimizing the amount of time that banks have to make money on our money, and we're maximizing the time that we can make money on our own money. The goal here is to always keep a responsible amount in our checking account. You always want to keep a responsible amount there. At the same time, you want to maximize the amount of money that you're filtering through that infinite bank. And in doing that, we've got $1 earned, which is $1 that goes into savings and $1 outside the policy. $2 for every one. Now look at these two interest rates on the screen right now. If you've stayed with me to this point, there's probably a question that's been brewing in the back of your mind, and I'm about to address it. I went out to bankrate.com and I found out that the average personal loan interest rate is 11.05%. Now, if you're borrowing money from your infinite bank, you have to pay yourself back at 5%. Wait a second. If I'm not using my money, if I'm using other people's money, if I'm using the carrier's money, do I have to pay that back? The answer is yes, and that's a good thing, and I'm going to explain why right now. Now remember, just a couple minutes ago, I shared that the past 3-year performance has been 5.8%. So if your cost is 5%, but you're earning 5.8%, how much are you actually paying on that loan? Right, negative 0.8%, which means that you're getting a positive arbitrage. You are earning income by lending yourself money. This is your side hustle for doing nothing more than what we all have to do, which is finance our daily lives. You have just become a bank, and you are earning the income of a banker, which is interest. Now let's take this a step further with an example. Let's just say that we want to borrow $20,000 from our local bank down the street. I'll call it Bank of America. Okay, we want to borrow $20,000, and we negotiate that we're going to pay it back over the next 7 years or 84 months. So I'm going to go out to nerdwallet.com. We can all get there. It is a site with a lot of financial calculators, and I used it for this purpose. Now, I actually thought that 11.05% sounded a little steep. So I'm going to scroll on down this page on NerdWallet and see what they have to say about the cost of personal loan rates. And you can see them here, right? I'm not talking about charging 14%. I'm not talking about charging 21 or 23%. I'm going to give everyone the benefit of the doubt and keep it at 11.05%. If I put in here that we're going to borrow $20,000 over 84 months, then you can see here that we're going to be paying $342.97 every month. And over those 7 years, we're going to pay not only that $20,000 back, but we're going to pay another $8,800 in financing fees, in interest fees, making our full payment back over $28,000. Wouldn't you rather be the financial entity earning some of that $8,800? I would. Now, what if we took that same $20,000 loan from our infinite bank? Here's how this looks. First off, we're not going to be paying $342.97 because we're not paying 11.05%. We're paying 5%. And so we're only paying $283. So at the end of 7 years, we're not paying $8,800. We're paying $3,700. Now remember I said that you can only borrow up to 90% of your cash value. So if you're borrowing $20,000, that means that you've got $22,222 in your infinite bank. And that $20,000 doesn't go anywhere when you use it. So over 7 years at not 5.8% interest, but I'm going to lower the interest rate down to 4%. Remember I told you that infinite banking from this one carrier hasn't paid out any lower than 5.6%. I'm going to take it down to 4%. And 4% compounding interest over 7 years on your full $22,000 is $7,000. Now, if you take that $7,000 and you subtract your $3,700, that means that you made a net profit on $3,200 by loaning yourself $20,000. You are a bank. You are earning the income of a banker, which is interest. When was the last time that you were paid money to loan yourself money? Now let's take this a step further. Look at the $3,700. Where does that go? Well, what happens when you put more money into a life insurance policy? It raises the death benefit. And because the death benefit is attached to the cash value, it also raises the cash value. So you've got a win-win here. You've also got a win with that $3,200 in interest. Now let's look at this scenario. Remember, I told you that when I first heard that I had to pay 5% interest on loaning myself my own money, I didn't think that was a great idea, but we've already covered off on that. But what if we take it a step further, and instead of paying ourselves 5% interest, we decide that we want to pay ourselves back at the same rate that any other lender would charge us, say 11.05%. What does that do? Well, first things first, we take an 84-month loan down to 60 months. The next thing it does is that it earns us more money in interest. And as we pay more money into the policy, our death benefit goes up, our cash value goes up, and the money that we're making goes up as well. Now let's take the hypothetical situation that you didn't go with infinite banking and you just took a $20,000 loan from Bank of America. Great. But all of a sudden you come into some kind of financial hardship. Maybe you got laid off. Okay. At that point, can you go back into Bank of America, go to that corner office, to the bank manager or whoever that loan officer was that initially hooked you up with that $20,000 loan, your buddy? And can you go to your buddy at Bank of America and say, you know what? I just got laid off. I know I'm supposed to pay you guys $342.97 a month, but can I lower that to $50 a month for the foreseeable future? Do you think they're going to say yes? No, they're not going to say yes. They might give you a grace period, but they're still going to come back to the fact that you owe them $342.97 a month. But with this, you own the bank, you own the loan, and you have the power, you have the control, and you have the flexibility to do anything you want. In fact, you can get a bit of a split personality and say, self, I know I'm supposed to pay you $342.97 a month, but I would like to take that down to $50 a month. Is that okay? And then you turn back to yourself and you say, you know what, self, you're a pretty decent human being. I'm totally okay if you want to pay back at $50 a month as opposed to $342.97 until you get back on your feet financially. Go for it. It's as simple as that. Now, does paying back a loan at $50 a month as opposed to $342 a month extend the duration of the loan? Of course it does. We're not talking about magic here. We're talking about math. But you don't have to worry about asking permission from anyone. This is your bank. This is your loan. You do what you want with your money. Here's another hypothetical. Let's just say that you took that loan from Bank of America, $20,000, and you're paying it and you're paying it off. You've got it down to about $10,000, and God forbid, you've got a rough day on the drive home and you pass away. Do you think that Bank of America, in all of their generosity, great organization that they are going to go to your family and say, you know that $10,000 that your loved one still had out? You know what? Just forget about it. Don't worry about paying it back. We're going to wipe that slate clean. You don't have to worry about that at all. Unfortunately, no. Whether it's coming out of a spouse or your estate, ultimately they're going to say, you know that $342.97, it's due on the 15th. We're deeply sorry for your loss. But with this, your loan, if you took it from an infinite bank, your loan is attached to a death benefit. So let's just say that you've got $10,000 left on the loan, you've got $1 million death benefit. When you pass, the carrier pays off that $10,000 debt, and the remainder goes to your family tax-free. Here's another hypothetical situation. What if you took my advice and you're filtering as much money as you possibly can while keeping a responsible amount in your checking account, but you reached the peak of your income earning potential and you're filtering a good portion of that through your infinite bank. You're maximizing your income. You're minimizing the ability for the bank to earn on you. But then you turn 65 or 67 and you want to retire. Can you change the amount of money that you're filtering through your bank? Absolutely. Here's how that looks. First, you can see the number one, the premium payments are split into two pieces. The first go to paying the policy. It creates the structure of the infinite bank. It creates the floor, the ceiling, the walls that give us all of these benefits that we're talking about. Anything over and above the cost of that insurance policy just goes directly into your cash account in your infinite bank. And after the first month of your payments, you can lower that down to $50 a month. On the other side, we already talked about that, your loan repayments. When you're paying loans back to yourself, you have the ability to lower them down to $50 a month or increase them, right? You have that control, you have that flexibility, you have the liquidity to do whatever you want to do. And what we're doing here is taking advantage of Section 7702 of the IRS tax code, which basically states that you can overfund a life insurance policy and pull out those funds right back out tax-free. Because loans in this country are not taxed. And death benefits in a life insurance policy in this country are not taxed either. But in order to stay tax-free, your infinite bank must be structured by a qualified and licensed professional so that your cash value never exceeds your death benefit. Because if your cash value exceeds a death benefit of a life insurance policy, then it's no longer a life insurance policy. It's a financial investment vehicle. And that is when the IRS steps in and says, guys, you had a lovely life insurance policy. Now we're going to tax you on your profits and gains. And what that's called, that threshold, when you have more cash value than you do death benefit, is called a modified endowment contract, or a MEC. And we structure these programs so that they don't MEC. I say that infinite banks act like a Swiss bank but live locally. Profits and gains within your infinite bank cannot be seen or taxed by the IRS. If you're ever sued, funds within an infinite bank are tort-free. They're protected from plaintiffs. And finally, 529 plans. Now, a lot of people are saving up to put their kids through college or their grandkids through college with 529 plans. What they might not realize is those 529 plans count against income. And the more income you have, it means that you're qualified for less federal student funding from FAFSA. So the more you make, the less you're qualified to get in student aid. But not with an infinite bank. They can't see into it. They don't know. So go ahead and put your money into your infinite bank. Get as much student aid as you want to. Let those funds grow while your kid's going to college. And when it comes time to pay off those college loans, take them right back out of your infinite bank and pay them. Now that handles the fundamentals of infinite banking, but let's see how it works in action. First off, you've got your premium payments. They go into your participating whole life insurance policy or your infinite bank, and it does two things. It gives you a tax-free death benefit, and it gives you a tax-free compounding interest account. That's it. That's all it does. Now let's look at how banks make money. I think we all pretty much know this, but for every $1,000 that we put into a savings account in a traditional bank, if they are providing you 1% simple interest, and I think we've already established that that's not the case for the majority of people, right? 0.42% is the average. For every $1,000 that you put in there, if you're earning 1%, at the end of the year, you'll get $10. Now, over the course of that year, the bank will loan out your money at least 7 times before you see that money again. And so that's $705 they're earning for every 1,000 of hours that we put in. Now they pay us $10, and so they make $695 at the end of the day. Not a bad business. Now here's how insurance companies make their money. Our premiums go into the insurance carrier's general account to invest. Now once that's in their general account, they invest in 2 specific places. Their retail side, where they loan out money to third-party lenders like credit card companies, banks, auto companies, mortgage companies, who then mark up and offer those loans back to you and me. If you didn't catch that, take a look at that again. If you don't know what infinite banking is, I hate to say, you're already using infinite banking, it's just being used against you. Secondly, they have a wholesale side, where participating contract and policy holders are given priority to borrow money at a fixed rate, like 5% fixed simple interest. Now here's how we make money with infinite banking. Let's just say you've got $20,000 in your compounding interest account, and you want to take $6,000 out to go on a nice vacation with your family. So you take out $6,000, and you decide that you're going to pay yourself back over 2 years. Now, over those 2 years, you're going to pay yourself $317.48 in interest fees. Now, your death benefit, let's just say in this example it's $500,000, is used as your collateral. 90% of your cash value will always be your credit limit. This is not one of those situations where you have $10,000 in your infinite bank and you want to borrow $100,000. Doesn't work that way. Now, repayment terms are entirely up to you, but in this case, it's 2 years. Now, I gave everybody the benefit of the doubt again, and instead of using the 5.8% interest that they've been issuing over the past 3 years, I took this down to 4% compounding interest that you're earning on the full $20,000 over 2 years means that you earn $1,632 for lending yourself $6,000. Now let's see how this looks with some basic line item math. So your interest income is $1,632. Your expenses are $317.48, which means that you made a net profit of $1,314.52 for lending yourself $6,000. You are a bank, and you are earning the income of a banker, which is interest. Now here's a scenario that most people are familiar with, buying a car. Now I looked online and I found that the average car price these days is $48,000. So the first person buys a car with an auto loan. And over 5 years, that person on a $48,000 loan is going to pay over $6,500 in interest. So over those 5 years, that person no longer has access to their $48,000. They're going to pay $6,500 in interest, but they own the car. Now, this doesn't take into consideration that the car starts depreciating the minute you drive it off the lot, but that's a different issue. What we're looking at here is a lose-lose-win scenario. So the next person says, well, forget paying $6,500 in interest, I'll just pay cash. So they go to their bank, they pull out $48,000 in a sack of money, and they walk it over to the dealership, and they put that sack of money on the dealership's counter, and they give them their $48,000. Now, over the course of that transaction, they no longer have access to their $48,000. However, they paid zero in interest, and they've driven off with the car. They own the car. So it's like a lose, break-even, win. Good for them. So the third person says, well, you know what? I've got 50 some odd $1,000 in my infinite bank. I'll just take $48,000 from there, and I'll buy the car. Now, over those 5 years, they're going to pay $6,300 in interest, but they're going to earn $11,555 in compounding interest. So what does that break down to? Well, it means that over the duration of those 5 years, their $48,000 never went anywhere. They also made over $5,200 in interest, and they own the car. It's a win, win, win. In fact, from a net equity perspective, they doubled their net equity and made $5,200 in the process. Now here's a scenario that a lot of my clients use as well. They pay off their monthly bills with a rewards credit card, like a Southwest Rewards Visa or an American Express cash back. But essentially, they take a good portion of their income and they filter it into their infinite bank while keeping that responsible amount in their checking account. Now at the end of the month, instead of paying American Express $300 a month, they take a loan from their infinite bank and they pay off American Express in full. So instead of paying American Express $300 a month, they've taken a loan from themselves and then they pay themselves back $300 a month, in which case they're earning interest on paying their monthly bills. At the same time, they're double dipping because they're getting cash back, they're getting points back, they're getting flight miles, whatever they want. It's their money. They're just getting more of it, and their money's working harder for them. Other scenarios include paying your taxes. Some of my clients know how much they're going to pay, roughly, to the IRS every year. So they take that amount, they split it up by 12, and they deposit that into their infinite bank throughout the year. When April comes around, they take that money, they give it to the IRS, but the money still sits in their infinite bank, earning compounding interest, saving for their future. How about investment opportunities? I have plenty of investors as clients who originally came to me and said, Derek, I don't get out of bed for 5.8% interest. I say, great. I'm a firm believer in diversifying your portfolio. But at the end of the day, where do you bank? Because if your bank isn't providing you non-direct loan recognition, if your bank isn't providing you 5.8% compounding interest, if your bank isn't sheltering you from taxes, then you're missing out. Also, I know as an entrepreneur, you're going to have good months and you're going to have bad months. Wouldn't you rather hedge your bets knowing that even in your bad months, your bank, of all places, is going to continue to earn you money. But how about tuition costs, vacations, loans to friends and family? How about this one? That friend or girlfriend from college who's your best friend, has been forever, and they come to you one night and they say, listen, I hate to ask you this, but I'm in a bad spot. I need like $1,500 or they're going to take my home. Aren't you going to feel better knowing that you can loan that friend that $1,500? And while you've loaned that $1,500 and they've saved their home, the money never left your bank account, and it's still sitting in your bank account, earning your compounding interest and saving for your future. And when that friend does pay you back, because they're that type of friend, you made money in the process. Business expenses is anything you want because it's your money. You do with it as you see fit. How about this? Take a look at these lists of companies. Include the Fitzgerald agency. What do you think they all have in common? Well, they all use infinite banking to run their businesses. But here's where it started to hurt when I finally understood how all of this worked. All of these banks use infinite banking as well. In fact, according to this report about bank-owned life insurance, or BOLI, that came out in March of 2023, Bank of America has $24 billion worth of infinite banking that they use. Wells Fargo has $19.4 billion. Chase Bank, $12.2 billion. PNC Bank, $10.7 billion. Truist Bank, $7.6 billion. Guys, this is just the top 25. It goes on and on and on. And the fact of the matter is that whether or not you realize it, you're already using infinite banking. It's just being used against you. Now, you don't have to have debt in order to make infinite banking work, but if you do, it's like that chocolate peanut butter combination that there is nothing else out there like it. Now, we did not invent the debt snowball, nor did we invent the debt avalanche. They've been around for decades. They're tried and true methods of debt elimination. What we do have is a proprietary piece of software that takes your numbers, your principal balances owed, your interest rates that you're being charged, the minimum payment that you're required to make every month, and what you're actually paying if, in fact, you happen to be making any overpayments. And it crunches that, and it builds a report that tells you the fastest, most effective, most efficient way for you to A, get out of debt, and B, build wealth. So for those of you who don't understand the debt snowball, here it is. You are paying off your smallest balances first, and with the debt avalanche, you are paying off your highest interest rates first. But it's not a one-size-fits-all solution for everybody, and that's where our software comes into play. Our software tells you the fastest, most efficient, most effective ways of getting out of debt, and then it builds you a report down to the day, the date, and the penny of when you're going to be completely out of debt and how much wealth you're going to build over 20, 30, 40 years. This is an actual screenshot from one of my clients. All right, guys, this is stuff that I see every day, multiple times a day. All right, we've got credit card debt, loans, timeshares, car debt, vacation, student loans. And you can see their interest rates range anywhere from 2.8 to 18%. And you can see what their principal balances that they owe, what their monthly minimum payments are, what their actual monthly payments are. Now you can see they've chosen to round up on their car payment because they want to shorten that loan period. And they've also rounded up on their credit cards because they don't want to have to pay those 18% interest rates. Now what's not on this page is their mortgage. That's on another screen. But with these consumer debts plus their mortgage, and that especially that student loan, this family would be paying their debt over the next 40 years. With their debt elimination program, they're not going to be paying for 40 years. They're going to be completely out of debt in 8 years and 11 months. Now you can see here that their payments prior to their debt elimination plan was $2,127.93. The new payoff plan is still $2,127.93, the same amount down to the penny, but not 40 years worth of payments. It's 8 years and 11 months. And oh, by the way, they're going to save nearly $110,000 in scheduled interest payments. I can't tell you just how emotional some of my appointments can get with my clients because they start seeing what's possible and things that they never thought that they'd ever experience in their lifetime. But it goes beyond just becoming debt-free. Now, this family was going to be paying for the next 40 years, paying those student loans. And in 40 years, they would just be finishing paying off that last loan payment. At 40 years, they have $1.9 million in assets. This is a phenomenal program, and I hope you can see now why I'm so passionate about this program. Why I stopped all my friends and family and said, stop what you're doing, listen to me, give me an hour. And why I feel amazing every time I talk to a new client and say, hey, by the way, we got you out of your debts 20 years faster, and we saved you nearly $110,000 in interest payments. This is literally rewriting the financial futures for my clients, and it can for you too. So if you like what you've heard so far and you want to learn more and see how your numbers play into this system, what are the next steps? Well, here you go. First things first, gather your most recent statements. This is not a one-size-fits-all solution. In order for us to customize a plan specifically to you, we'll need to understand your financials. That means any existing assets that you might have, like IRAs, 401ks, annuities, or the amount in your savings. We'll also need your monthly expenses. What does it take to run your household? And when you're paying something that has an interest rate, please include the balance owed, the balance being charged or future interest if it's been deferred, the minimum payment required, and your actual payment, just in case you're making any overpayments. For mortgage payments, please only include your monthly principal and interest payments, not any taxes or escrow that get factored into your mortgage payment. Then we need to know your annual income. Now, if this program is something that you want to do with your spouse, then please include their income too. And finally, schedule your Zoom meeting using the link below this video. We only do these meetings over Zoom so that you can see us and our screens, just in case we need to use visuals to explain the concepts we're discussing. We also like to see you, so please turn your camera on. Please be in a place with a steady internet connection. On the day of our meeting, please be on time and ready to go in a space with limited distractions. I'm sorry, but these concepts don't translate well when we're trying to explain them to you on your drive home from work. And finally, if you need to discuss this program with a spouse, a friend, or a financial advisor, please invite them to the call as well. We're happy to talk to them too. Thank you so much for your time today. I truly appreciate it. I look forward to being able to help you and your family in the future. Take care. See you soon. Bye-bye.